All right, hey everybody. Today is Monday, February 9th, 2026. It's Luther Wilson III, real estate extraordinaire here in the Kansas City market, representing for Upside Property Services and the affiliate companies. We are here helping sellers, buyers, investors, and people with capital get to it in one way or another via real estate. So I appreciate you tuning in. I did a video a couple weeks ago regarding some of the misconceptions or misunderstandings around real estate investing. There are three big things that I refer to time and time again on previous videos, and it has to deal with the capital, the strategy, and the operations. But beyond that, we as investors or real estate service providers have to understand, the perspective of our clients. And I think this video will help. The last video that I mentioned that I did a couple weeks ago may help you if you're wanting to invest, or again, if you are a service provider like myself or an investor like myself, it can help you have a better understanding of what you or your client or your partner or your colleague, whoever you're trying to assist, may be going through. Okay, so on that video a couple weeks ago, I listed off and went through and gave some information about three of the biggest expectations or assumptions that investors make. Okay, and then last week I did a follow-up covering three more expectations or assumptions that investors make as part of the process. And so in today's video, I'm gonna talk more about how we can combat those issues, or how we can prepare ourselves as we're going in and going through that process. Okay, so the first expectation that I've seen time and time again, and I've struggled with it too, is that the lender will pay the full purchase and cover all of the renovation costs. Okay, so this really came to light as I was doing more of my own investments, growing my own portfolio, and then also as I was helping other investors to figure out their capital, okay? And I was helping other investors to source and secure funding for their own investments. And a common thing that, I noticed was that we think that we may not need any money, or, I guess if the opportunity is right, there are some situations where we have been able to go through the process without using any of our own money. But I want to clarify that that doesn't happen all the time. And there's a term that I use, and I know there's some other real estate investors use it as well, and it's called gap funds. Okay, so in order for us to be able to get through the process more effectively and efficiently, I think that it's critical to have at least a certain amount of capital set aside, or a certain amount of gap funds available. And if you don't necessarily have that going in, at some point you're gonna need to think about who you can reach out to for outside capital, because the lender is, for most cases, they're not gonna supply all of the capital that an investor is going to need. Okay, so whether you're going fix and flip, or whether you're going turnkey, or you're using the BRRRR strategy, okay, the lender usually is going to supply a certain amount of money up to a certain percentage of the property's current or after repair value. And then the rest is up to you and whoever else is involved. As I mentioned, it could be a business partner, it could be an associate, family member, or a private money lender who is going to need to step in at some point or another to put up additional capital to cover those gaps. So in order to combat, that, something that I've been pushing a lot harder the last few years, whether it's with a client or with a partner, I've had to vet them a lot harder to make sure that we're not going in blind or unprepared. Even with knowing what our game plan is or what strategy we're going to use, and even with a certain amount of gap funds, I cannot tell you how many times we still ended up needing additional capital to get through the process. So the earlier the better. And again, this kind of goes against the grain from what a lot of real estate coaches or teachers and even some investors are proposing or what they teach. But there's a reason that I do that. I go against the grain because, I've gone through it so many times with clients and investors. So to combat that, you want to really look at and communicate with your lender and your capital suppliers, if you can, before you even start looking for deals. Okay, but if you are at a point where you are already under contract or you are currently looking for opportunities, you still want to be mindful about those gaps that you're going to have to fill. Okay, so I hammered that one. Point number 2, okay, a big an expectation for real estate investors, one of the biggest ones that I've seen is we believe that renovation projects will stay on time and under budget. Okay, so when I thought about this one, I thought about all of the projects that I'd been a part of as a property manager before I even got really serious about doing my own deals and growing my own portfolio. And then I also thought about all of the projects that I've done for my own investments. Okay, and this is a tough one because we want to have guidelines and we want to have a scope of work, and we also are going to have some type of agreement or contract for the renovation project. At least that's how we've done it, and I recommend that as well. When I've gone through the process, I'm usually the first one to walk the property, and I do my own scope of work, okay? And I would get pictures of the property, and then I would go back to home base or to the office or wherever I can, get on my laptop, and I'll review the pictures and I'll review my initial scope of work, and I'll modify and adjust going through a second time. And then I'll reach out to a contractor if I haven't already, and I'm going to walk the property with that general contractor or with that contractor or rehab crew leader, and I'm going to go through each room, each thing that needs to be addressed with that contractor. And then that contractor is going to go back to their home base or their office, and then they're going to have to collaborate with their service providers to coordinate not only the cost of the materials, but also the retrieval of those materials. Okay, so even with all of this, I do my scope of work at least twice. Then I walk the property with the contractor. They do their scope of work, and then I review that, okay, before we start the project. Okay, and even then, we have a tendency to go over budget and past the deadline for various reasons. And so going in, yes, as I mentioned, we have guidelines, we have a budget, we have a scope of work, but you are going to want to be prepared somehow, okay, however you got to coordinate it, to be able to access additional capital and to be flexible with the people who are doing the labor. Okay, some investors GC their own projects. Okay, cool. That's great. You can make that happen as well if you are in the trades or feel comfortable doing that or want to learn that process. But even then, there is a lot of coordinating and a lot of back and forth on virtually every project, from the simple ones where we just did a clean out and a cleanup, all the way to the $86,000 rehab that we did for an out-of-state investor, all the way through. Almost every single one of them, not all of them, but almost every single one of them ends up going past the deadline and over budget. So you got to prepare for that. For me to go in, okay, I'm going to drive hard. I'm going to check on the property every week or however we do it. But even then, I understand that I need to give my people some grace and myself some grace and go in with what I believe is the proper assumption and flexibility, knowing that, hey, we're probably going to need additional resources. Okay, so the times that I have had, there are two particular situations where someone asked me why we went over budget, and I just kind of had to laugh to myself, because anybody that asks you why you went over budget on a project, that lets you know their experience level. Maybe a better question would have been, how did it happen or what happened? But if you have to ask somebody why they went over budget, you haven't done enough. Anyway, on to the third point, okay? How can we combat, or how can we prepare, or how can we manage expectations more efficiently? The third biggest misconception or misunderstanding when it comes to rental properties is that they will cash flow, okay? So over the last few years, you may have noticed it, I have noticed it, especially in the multifamily space. There have been more multifamily resales and listings over the last 2 to 4 years than I had seen previously. And I would venture to say, based on, conversations and experience, me managing multifamily in the past, me selling some multifamily, and talking with multiple real estate brokers and property managers who serve investors or who do their own multifamily investments, have told me time and time again that, and it goes like, why I think that more investors are selling their multifamily properties is because they didn't necessarily cash flow like they thought they would. Okay, it's one thing to look at an opportunity on paper or on a one-pager or on a spreadsheet where you have all of the general breakdowns for the cap rate and the net operating income and so forth, and it can look real sweet on paper. But what a lot of investors and even service providers may not really be able to see is the additional costs for the maintenance and the management and operating expenses. Because if you have a multiplex, essentially that's like a business, okay? And in order for that business to perform, right, it goes back to the capital, the strategy, and the operations, okay? And then even beyond that, as I mentioned before, going in with the right mindset or, reasonable or appropriate expectations is huge. I mentioned on that video a couple weeks ago that I have a mentor who owns several rental properties, and he's been in the business for almost a decade. And when I think of what he told me really just a few weeks ago, I think it's reasonable advice for some investors out there, not everybody. But he goes in assuming that he's not going to cash flow. He does not care about cash flow, okay? And again, I have to distinguish between a traditional rental property and, what I do or what a lot of my, clients do as seller financing. There's a difference there. So with regular traditional rentals, whether you're going long-term, short-term, medium-term, or whatever, we oftentimes, or a lot of my clients in the past have often expected that the property manager would cover expenses, and that after paying those expenses plus the underlying debt, which usually includes the taxes and insurance, the assumption is that there will be profits or proceeds at the end of the month or at the end of the quarter, which may in some cases happen until you get to a point where that ends. And again, I mentioned property management costs and issues, and then there's maintenance, deferred maintenance, upkeep of the units, and then operating the business. Okay, as a business, there are operational costs that come up, whether it's a citation or a lawsuit, or you having to pay someone to make sure that the books or taxes are done appropriately, and the list, attorney fees, and the list goes on. So that, is one way to combat it. I would say if you are intent on holding rentals of some sort for an extended period of time, going in knowing that, okay, this may not cash flow as I want it to or as I hope that it would, but I'm going to treat it like a business. I'm going to take care of the property. I'm going to each year raise rents. I'm going to continue to pour in to do upgrades as units become vacant, and I'm going to be on point and be a good steward for that multiplex or single family home rental or single family portfolio. It doesn't matter either way. And then it's a certain point when you exit, right? Whether that's through a resale or through maybe a 1031 exchange, then you will be able to see the upside, okay, of that business or of that investment. And that's usually when you get to enjoy it. Not so much when you go in, and maybe a little bit along the way during that holding period, which is another reason why we push for our investors to stay in for at least 5 to 10 years. And then from there, as you are restructuring, repositioning, refinancing, reselling, upgrading, 1031 exchanging, or however you desire to do so, then you can truly enjoy it. That's one big way to combat it. The other big way to combat it is to do something a little bit more creative, which is what we push for a lot. And that's why we do single family home investments, and that's why we are able to do seller financing on those, because for various reasons, okay, two of which, the residents take care of the property. So that eliminates our overhead as far as maintenance and property management. Another big reason, right? Because why we do seller financing is we are able to offset the costs of the taxes and the insurance and some of the other operational expenses. That is because the residents in the home are taking care of that. So that is a huge way that you can, combat that expectation, if you will, or, look at ways that will more consistently and more predictably, and I think more for the long run, seller financing is a great way to do that. Okay, so appreciate y'all tuning in. This wraps up part one of how you or how we as investors or service providers for investors can combat and go in more prepared and with more reasonable expectations on those three big ones that I mentioned a couple weeks ago. So stay tuned. I'll circle back in the future and do another video on how we can combat or go in more prepared for those other three big expectations or assumptions that we have as investors. So thanks again. Have a blessed day. All right. Peace, y'all.